watching Stock Watch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Mark du Toit from Oyster Catcher Investments and Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Thoroughly impressed with the commodities today, and particularly DRD Gold. And funny enough, Mark, this is the day after DRD Gold released their results, and there was actually a muted reaction from the market yesterday, but now up 14%. What's been happening?
Yes, so seemingly a little bit of a delayed reaction, and maybe, sometimes it takes a bit of time to digest the results. The analysts have to present to the investment committees, and someone wanted to buy a bit of DRD today. The liquidity is not that high in DRD. It's it's one of the smaller companies listed on the JSE. So if you want to buy a big stake, you will move the share price quite a bit. I think they did have a good update yesterday. Operationally, the business is good, but the real excitement I expect is because they have been extending their tailings facilities. So this has been a project which has been on the go for a while now. And from 2028, they'll be able to increase their throughput through their plant, and they'll be able to produce, instead of 5 tons a year of gold, they're going to increase to 6 tons a year of gold. So you've got a nice company that's growing its top line, well supported by a strong gold price. And what's nice about the companies that do processing of tailings is that you've got a lot less mining risk. So typically they deliver on their promise. They know how much they can put through their plant, and it's less likely that they have the kind of disruptions that a normal mining stock has. So they don't have the fall of ground issues. They don't have you're running into a fault that you didn't know about, and your mining is a bit of a setback. They don't have those issues, so typically they trade on higher multiples than miners do.
Yeah, I mean, I'm quite surprised by this move, that the sharp move that we're seeing on the gold counters today, Grant, because there seemed to be a narrative recently that people are moving their positions away from gold and actually going into PGMs. I mean, should one still be keeping a close eye on these gold counters at this point?
Yeah, definitely. There has been that narrative. I think they serve completely different purposes in the portfolio. So you can rotate from gold into PGM, your portfolio changes completely. I think one needs to be careful about associating the two together. Gold and silver maybe a little more closely aligned. But I think gold it led last night in the US. We saw gold stocks perform really well, and that was carried over today. And I still think it has a place in the portfolio. I think given the geopolitical risk that still remains, and many other risks around inflation, tariffs, interest rates, you name it, gold is serving a very careful and steady purpose in the portfolio. And I would be quite happy maintaining a small piece of gold exposure.
All right. Well, I want to get into some of the numbers that came out today. Okay, since we are already on commodities, let's go into Exxaro. And I think for me, what surprised me, Mark, is the kind of strong performance that they're seeing in their coal business in a time when the other coal miners are actually not having such a great time. What did you make of those numbers?
Yeah, I mean, a good result. So the share price was up 8% because it did beat consensus estimates. What was nice to see was the cost control coming through. So Benguela, the new CEO, he said that each mine has got 5 projects on the go, all looking at efficiency and savings, and that really helped them beat on the cost line. So even though the coal prices are lower, the EBITDA actually went up because they're able to control their costs. Also, there's been about a 10% improvement in the amount of tonnage railed on Transnet, so that benefited the volume side. And I think also the market likes the fact that they are now talking about having a relook at their dividend policy, reducing the amount of cash that they hold on balance sheet, which potentially means higher dividend payouts. So the market's getting a bit excited about that and looking to rather consolidate the manganese transaction that they've announced, and looking less. I mean, they actually talked down the possibility of going into bauxite, which they've talked about before. So it doesn't sound like that's a priority for this moment. So yeah, overall, I think it beats on quite a few metrics.
I mean, it's quite interesting that when we talk about diversified miners, people don't necessarily talk about Exxaro. And of course, we know the path that they are on now. I spoke to the CEO, and he also spoke about, I think, copper at some point. But obviously, we know now that they are busy with manganese. Grant, would this be one worth putting into your diversified miners portfolio? Maybe not even now, maybe at some point in the future.
I think maybe at some point when the strategy becomes a little clearer. So when I look at that 18 billion of net cash, it worries me. It doesn't excite me because, it's like burning a hole in the pocket kind of thing. So I'd love them to pay it out to shareholders or be very clear about what their strategy is. They have pivoted once or twice with renewables and now into manganese. And where does the next pivot go and how much money gets thrown at it? So I think they should stick to their knitting. Remember, they do have some iron ore still through Kumba. And so you're getting, I think it's quite diversified, but it's not a diversified miner in the truest sense.
Okay.
But they have done well, and I think another attribute was, from what I've seen, is that they were selling more coal overseas, and they don't have the same regulatory pricing or the kind of pricing contracts overseas that they do with Eskom, so they got a better realized price. And so I think that's a positive if they can see more of that. So I mean, it was a good number. It was well better than expectations. I'd like to see the strategy be a bit more clear, and to understand what they're going to do with all this cash before I would rush into this one.
Okay. Well, here's something that I didn't expect. When we talk about these restaurants, of course, we heard from Famous Brands a couple of months ago that the money that goes into online gambling is eating consumers' disposable income that they would normally spend at restaurants. But Spur also added an element that the retailers are actually a challenge that they are dealing with right now in the competitive landscape. Mark, would this be a thing of now restaurants competing with retailers?
Yeah, I mean, I actually thought that the number that they printed today was good. I mean, like you mentioned, Famous Brands talking about people's wallets being under pressure, spending money elsewhere, not eating out as much, and Spur came out with 8% top line growth, and I think it was like 17% in earnings growth, which is a really nice number. So yeah, it's a bit of a disconnect there for me. I think that, look, I mean, I've been more positive on the South African economy than most. I do think that we are seeing real wage growth. We've had interest rate cuts. Those are slowly starting to filter through now into the economy. I mean, there is a little bit more in people's pockets, and I think that will start to come through more now in the second half. I think we have a bit of a false start with all the Trump tariff news. I think that people have been overly worried about the impact on the agri space. So I think that confidence might come through in the second half. So I think that Spur printed good numbers, and I think that they should be able to continue that into the second half.
Spur, and I mean, Grant, Spur is literally the, outperformer when you compare it with Famous Brands there in that listed restaurant space. Would this whet your appetite in any way?
Yeah, I think it was a great set of numbers. There's a clear difference between those who are operating well and those who aren't in this tough environment. And you can see that across sectors, across whether it's retail, whether it's financials. It is not easy out there, and some are executing well and some are battling. So if you're doing well, you're taking share from someone else. Interestingly, what Spur did say is that their footfall only increased about 1%, but their spend increased about, I think it was 8 or 9%. So people are spending more, and that talks to what Mark was saying. I'm also in the optimistic camp. There's a little more disposable income around. For the, if you've got a proposition that people like, you can tap into that disposable income. Think also of the petrol price. The rand is at multi-year highs, and you've got the lower oil price. That's also filtering through into the pockets with the interest rates and the real wages, etc. So I think at the margin things are a little better, but it's not that everyone's benefiting equally. And so you have to be very careful with your stock selection. I still think Spur's cheap here at around 10 times earnings, I think, even with this move today. So it's not a bad little stock to have in the portfolio. They know what they're doing.
Yeah, it's quite an interesting point that you make there, Grant. A lower footfall but higher spend. And actually, when I spoke to the CEO, Valnegas, she said that people aren't going regularly, but they are going for special occasions. So I guess you're going with your family of maybe 10 and you're celebrating a birthday, and of course that equates to more spend. Let's go into Boxer before we go into the break. Is Boxer a buy at 70 Rand per share? Somebody asked, is Boxer a buy at 66 Rand, 67 Rand a share? But now it's moved higher. Mark, what can you say about a buy on Boxer?
Yeah, I mean, we still like the business. I mean, yes, it has done well, but it's one of the few companies in South Africa that has articulated a nice growth strategy, that still has opportunity to open more stores and to grow its earnings. So yeah, I mean, even though that it's done well, I think at 68 or 70 Rand a share, I think you can still buy it, and it's still going to grow and yeah, continue to deliver into the share price.
Right, yeah, today it's up about 3%. Grant, your take on Boxer at this current level?
Still like it. If you're thinking beyond 6 months, you can buy it. You know, longer term, definitely you can put it in the pocket.
All right. Let's get to the next questions. Should I buy Aspen at 110 Rand? I'm not sure if it's going to stay at 110 Rand tomorrow, Mark, as they released their trading update at 17:40 after market close today. Did you get a chance to go through that?
I haven't been to the full detail of it, but I saw that earnings are going to be down 30%. When I was looking at what our expectation is, it is pretty much in line with what we expected.
Okay.
Yeah, so I wouldn't say that it's going to be a rosy start to the day for Aspen, but it all depends it depends a lot on what they can do with the additional capacity that they've got. They did lose a big contract when all the tariff news broke, so they have to find a new home for that capacity, or perhaps they were looking at selling capacity. When you buy the Aspen at this price, you're not paying for this additional capacity that they've got. I mean, so if they are able to fill it, I mean, that will be upside for you as a business owner. So yeah, I mean, Aspen's actually a business that we like, that we are overweight. So we'll have to see how the market reacts tomorrow. Hopefully, it's not down too much, and if it does go down, we might actually buy more. We'll see.
They say that they demonstrated a resilient performance during a challenging financial year. Of course, we know how challenging that has been on the share price as well. Yeah, Grant, would you say that this was not a surprise at all?
No, I don't think the result was a surprise. And I had a quick scan. They do talk about their core business, so I guess the one excluding this massive 2 billion contract, being double-digit growth in revenue and normalized EBITDA. They've launched Mounjaro, so that's that diabetes drug, and with Eli Lilly partnership. So they're putting a good spin on things. It's not clear to me how much is in the price. I don't really know if what that core business is kind of worth at the moment, but I would argue that if you're kind of getting optionality here. So if you're comfortable with this price for what's left of the business, then if your downside is that they don't get another deal and they don't fill that capacity, and your upside is they get a deal done and there's some optionality. So it probably starts to look a bit interesting here. I don't have the confidence that something comes to the table that quickly. But I can see the appeal of having a nibble around these levels.
Okay, all right. Well, people have been having a nibble at British American Tobacco, and the question says, why is British American? Yeah, why does British American Tobacco keep going up? Well, this was sent late yesterday. It was up to 2.7% yesterday, and yeah, it's been just going up and up and up. Mark, why?
Yeah, well, I mean, there's been a real change in sentiment towards the stock. If you think back a year and a bit ago, there was a lot of pressure coming from the FDA to ban menthol cigarettes. That seems to have died down a lot. I mean, we know the Republican, and Trump in particular, is not fussed about smoking, and it probably plays to his base. So that noise has gone away. Plus, the new generation products have been growing faster maybe than what the market was expecting. The next step is hopefully that in America they can get a handle on the illegal vaping. So British BTR sells legal vaping products, and there's a lot of competition from products that come in and are sold illegally. So there is some optimism that they'll be able to get a handle on those illegal vaping products. But really, it has been a re-rating story, a change in sentiment towards the stock. The earnings still haven't grown. They do make great cash flows. They are paying down debt. But yeah, seemingly the market is prepared to pay a high price for those earnings than it was a year ago.
Yeah.
I mean, we think that the re-rating story is kind of starting to run its course now, and we've been selling down our stake.
Well, interesting, because I mean, people have been saying that it's behaving like a growth company, and this is the thing about a growth company. You'll think that it has run too hard, and then it just keeps on running. Grant, I mean, for people who are just looking at this as a dripping roast and are wondering if they could still get in, what would you say to them?
It's funny, a year ago at 650, no one wanted it, at 5-6 times earnings. Now it's doubled or nearly doubled, and we're all interested. So I would just say it is a re-rating, and as Mark said, and I think one needs to not chase the stock. But what I also think is, this is my own personal opinion, is that people are starting to look through the slow growth, because it has been a value trap for quite a while. But they're starting to see the next gen product catch enough momentum and starting to build critical mass. It's not there yet, but if you look at Philip Morris, what they've done and the roadmap they've followed, the growth they're achieving now in their next gen portfolio, which is far bigger, it's 41% of the total earnings versus, I mean, BTI, I think it's a bit less than 15. So as they go, if you're taking a 3 or 5 year view, it still makes sense to buy a BTI now, but I think in the short term, it's done a lot, and that evidence of that growth is still in its infancy. So I would be very patient on this one. I wouldn't rush to buy it here.
All right. Going to America, what is your opinion of investing in US stocks or US dollar going forward? Mark?
Yeah, that's a very broad question. Where to start? I mean, I think that the way the American economy is set up is fantastic for capitalism. It's one of the few places in the world where people who make money and grow businesses are celebrated. I think that you have, because of the democratic system, you have a lot of protection for your intellectual property, for the businesses that you buy, which is different to somewhere like China. There is a lot of noise at the moment with President Trump. He really is stirring things up. He gets things done, which is to some people's benefit, and there are losers in this. I mean, if you had a business with a big manufacturing base in China and you're selling into the US, you have to rejig your whole supply chain, which, and I mean, we've seen companies like Nike and the like being hurt because they have to now, reorder their whole business. Or you can try wait it out for the next 4 years and see if the next president is going to have a different view. So I think in general, I think we like America as a place to own a business. It has been the place to be for the last 30 years, I would say. You have to decide, is it going to be like that for the next 30 years? It's probably going to be a little bit different. And also, the market is, especially in the tech space, it is looking a little bit expensive. You have to have a view on whether you think AI really is going to be a great money spinner. And we saw recently Sam Altman come out and say they're spending a lot of money on AI, but not a lot of monetization of the product, and could disappoint. And the other thing to say is, if you buy a business as a South African in the US, there's a 30% withholding tax on your return. So if the company declares a dividend, the US government gets 30%, you get 70%. So there's a lot of factors to think about.
I've been having a lot of conversations amid the elevated tariff landscape that now it's time to rotate out of the US into emerging markets. But I mean, it's quite interesting because Mark talks about the still resilient economy in the US, business-friendly environment. Grant, how would you be approaching this?
Yeah, I guess there's two questions. So the one is, as Mark said, America's a great place to do business. They have an environment of innovation and exceptionalism that has fostered these global leaders, the Mag 7, which are bigger than many
Yeah.
countries, entire GDP and the entire market cap. So I think that is why they will stay as a better economy, a higher growth economy, because they have a much clearer roadmap. We're moving into a regime that's business friendly and regulation light. They're trying to stimulate more private sector growth and reduce the crowding out from government. So I think those are all positive. But having said that, there is a hang of a lot in the price. I don't think if you're starting today that your entry point looks particularly attractive in the US. You're paying a high multiple, and there's no question about it, even if they deliver some growth. So you're getting a quality company. If you think of it like we compare companies, America's a quality business, but at a high price. You can go to Europe, you don't get the same quality, but you're getting a better price. So you almost have to choose your poison. I think there's value to be had in many places, including the US, but then you need to be a stock picker. And you need to, and I think EM is due a bit of an improvement. I think the commodity cycle is picking up. The weaker dollar favors commodities, it favors EM. And so you are seeing some opportunities there. But that's assuming you're going to be active and you're going to be deliberate about where you are at what time. If you took a 10 or 15-year view, I think the US outlook is still pretty robust.
Okay.
But be careful of short-term market multiples.
All right. Talking about robustness, let's get to your stock picks. Mark, where are you seeing opportunity today?
Yes, I'm picking Process tonight. I have picked it earlier in the year as well. We still really like the Tencent business. Just recently had the Q2 earnings, and revenues growing at 15%, gross profits growing at 22%. We think that even in 3 years' time, we think that the earnings are still growing at close to 20%, and you're paying a much lower multiple for these earnings. You're paying a 21 times multiple for these earnings, and on that basis, you get kind of a return of 18% a year in rands. Plus, on top of that, you've got Belosi, the new CEO of Process, and he's heavily incentivized to grow the businesses outside of Tencent. So Process owns Tencent, which is about 90% of the asset value, and he's heavily incentivized to grow the remaining 10%. I think that he will do well. He yesterday put out the CEO letters on their website. And he is going into, he also wants to build an ecosystem business. So if you think about Tencent, WeChat as being an ecosystem, you log onto WeChat, you can buy things on WeChat, you can pay for things on WeChat. He wants to do the same, but his starting point, he says, is going to be in the food delivery business. So he's been buying up food delivery businesses. Everyone's going to have the food delivery app on their phone, and from there you can add on other products and services. So I think it'll be interesting to see if he's able to achieve that, and if he does, I think that Process will be even an even better investment, because I don't think you're paying for that at this point in time.
All right. Well, what are you paying for today, Grant?
I'm paying for Discovery Health. I think you're going into a nice situation where they've got some of the maturing business, the life and the health that's been there a long time, and that's like the cash cow. And then a lot of the investments that they've been making into organic growth, be it in China or gaining traction through Ping An and some of the other areas in Vitality Global, and you're seeing the Discovery Bank monetizing a lot quicker. So I feel like their requirement to invest is reducing, and they can start focusing on the profitability and monetizing these growth opportunities. And I think you're going to see that continue over the next few years. You're going to see more profitability, more margin expansion, less capex, so more cash flow generation. And I think to me that looks attractive, and I think it's a good entry point. It's been consolidating. It had a good move last year, but it hasn't really gone anywhere this year. So I think it's giving us a nice opportunity.
Lovely. Thank you so much for your time and for your analysis today, gents. Really appreciate your time. That is all for tonight's Stock Watch. Thanks to our guests, Mark du Toit from Oyster Catcher Investments and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.